Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates, and 10-year note yields posted their highest level since 2011. We got the highest level that we'll probably see for a while, given the fact that on Friday, after posting that 312.5 yield, we pulled back big time. We got back down to as low as about 3. So yields aren't going higher, but they're at least going to stall for a while, as the trade was to buy bonds on Friday as opposed to selling them, which we've seen for quite some time. Just note that 10-year note yields haven't settled below 3% since May 11th. So it's been a while. It's been about, when we talk about how hard it took us to get to 3%, we got there, we failed, we got there, we failed. We've been able to hold it for a while. That's a good thing, but I think right now we're going to try and trade the range, which would be somewhere in the low, near 3%, to somewhere just above 310. If we break out of that, then I think we'll have to, then we'll start to see a shift in momentum. But right now, the big move seems to have lost a little bit of its luster, the wind being taken out of its sails. And if you look at market volatility, yesterday we noticed that it had started to decline. Well, today it did decline as well. Heading into the weekend, we saw volatility decline despite the maintained risks. We won't even call them rising anymore. You look in the Middle East, Israel, Iran, over across on the other side of the world, you got North Korea, and you got, there's just still a lot of uncertainty in the world that's not being priced into the bond market, or if it is being priced into the bond market, it's not historically being priced the way we normally would see it. Flight to quality buyers are nowhere to be found, and I think that much of the buying that we saw today probably came on the heels of short covering, and I think that right now volatility remains cheap given the environment that we live in. So what could change? Well, ahead, next week we have 3 auctions, 2, 5, and 7 year. Recall last month we had a very poor 2-year, a mediocre 5-year, and actually a pretty good 7-year. But recall the 7-year was issued at about a 295 yield. Since then, we've seen 7 years get above 3%. So we do talk about 10-year being the benchmark, and that being above the 3% and moving up to 310. But the 7-year has also done the same. Not quite as high as the 10-year, but it certainly is now well above the 3% threshold. Will there still be demand? Obviously, it's a little bit cheaper now, but if we can anticipate them yields continuing to move higher, it'll be interesting to see how those 7 years are received. Likewise, we get durable goods. Durable goods, a good benchmark number. And last, we get a lot of Fed speakers. Fed speakers seem to be talking all over the map, as relative to the yield curve, which got to its steepest since March this week. Fed President Bostic had talked this week about that being one of the Fed's jobs, to keep the yield curve from flattening, which obviously it didn't flatten this week, but it did make a turn back towards those lows. We saw that 42 print in the 2s10s. Now we're well above that, but certainly we aren't on a longer, bigger chart. It's still a very, very small move that we've seen in the yield curve, and the Fed will probably continue to talk about that, although I don't think Fed speak had anything to do with the movement in the yield curve this week. I think it was all about the back end of the curve finally seeing yields rise at a pace that was faster than the short end. So right now we've got the bond markets, after a big move this week, big move higher in yields, things have cooled off a bit as we head into the weekend, but next week we have a lot of data, a lot of Fed speakers, and some pretty big auctions that could change all that. This is Todd Colvin coming to you from the floor of the CME Group.